Right, let's take a closer look at the Federal Reserve's decision to really do nothing, to leave interest rates unchanged for now, and what this could mean for stock investors.
Well, joining us now from Minneapolis is Bob Dahl. He's the chief equity strategist at Nuveen Asset Management. And Bob, you say that actually the Fed's non-decision or decision not to raise interest rates is a negative for equities. Why is that?
I think because it increases the uncertainty. The paragraphs accompanying their release had everything to do with things outside the U.S., and while they're not unimportant, to make that the whole story, not spending much time talking about the improved employment situation, for example, I think it threw a bunch of investors off, not knowing kind of, well, what are the goalposts here that the Fed's looking at? So it's the uncertainty that it creates.
Bob Dahl, I'm wondering if you could speak a little bit more specifically about asset classes. Let's begin with stocks. What categories do you like, and which categories would you like to get rid of?
So, Pim, we're in an environment, I think, where the uncertainty related to the correction in August and the healing process necessary in the market, the Fed issue we just talked about, the uncertainty about third quarter and beyond earnings. I think you want more balance in your portfolio. Eventually, we think free cash flow and value will win out, but I think you need some growth in there. So don't give up on your consumer staples and some utilities, but make sure you also have some consumer discretionary because of the domestic earnings that come from that. And, oh, yes, then there's healthcare and parts of technology. So I think it's a potpourri. I don't think being out on a limb in any direction makes a whole lot of sense at the moment.
Speaking of being not out on a limb, I mean, Jeff Gundlach of DoubleLine spoke with investors on Monday in his call. And basically he says there's a 50-50 chance that the Fed is going to raise interest rates in December. So there's really not much there, right? 50-50. Where do you stand, Bob, on that?
Well, I'll plead the fifth and side with Janet Yellen. It will depend on the data. Now, my view is the data will be sufficient for the Fed to go. So I'll go out on a little further on that limb and say 60-40 they raise in December. How's that, Betty?
Okay.
Bob, speak if you can about the energy sector. We know that stocks as well as the high-yield debt of many energy companies has sold off because of the slump in oil prices. Would this be a good time to start buying?
I'm still patient on that, Pim. I'd rather pay up and knowing I have better fundamentals at my back than try to catch the falling knife. I mean, we have slow growth outside the U.S. China has slowed, and they are a big incremental demander of oil. And, of course, you've got Saudi Arabia kind of pedal to the metal. You've got Iraq pumping oil.
Yeah, but, Bob,
Iran
don't you want to get ahead of all this?
Still doing a whole bunch.
But, Bob, don't you want to get ahead of all this? I mean, you want to buy when everybody else is selling, and you want to sell when everybody else is buying.
Only when the fundamentals are turning. If you're telling me that China's going to get strong tomorrow and that somebody's going to shut down supply, yeah, I'll buy them big time. But I don't see that happening, Pam.
Bob, you know, we've seen how bond investors and equity investors or traders, bond traders and equity traders have really kind of had two different views on the economy, and you know, and bond traders have been much more pessimistic about the situation. So knowing that the Fed obviously has held off on raising interest rates, does it change the game in terms of who you pay attention to? Who's the market and who's a trader that's going to be much more accurate going forward?
You know, I think you're right to characterize it that way, and the bond guys have had it more right than the equity guys. Look, I think a lot of it is the geography question that we've been talking about here. You know, how weak will China get? How deep will Russia's and Brazil's recession be? Can Japan restart the economic engine? Oh, and then there's Europe. What's that going to look like? Meanwhile, the U.S. is doing okay. The consumer's in pretty healthy shape, and you got to balance all of that out. And I think that leads to a world where economic growth is okay, but no better than that. And that's good for certain kinds of stocks. You got to have the earnings for the stocks to do okay, which means I think you have to have the free cash flow.
Bob, just quickly, what's your best and what's your worst call for the preceding 12 months?
Preceding 12 months, my view is that value stocks in the U.S. equity market were going to do better than they have. and I thought interest rates would move up and bonds would have more difficulty. So they're my two worst calls to answer your question.
All right. Thanks very much. Bob Dahl.